All right, let's jump right into the ultimate language of business. Whether you're scaling a startup or just looking to optimize your own financial foundation, this explainer is going to show you where everything begins. Today, we're breaking down the 5 essential buckets of accounting: the language of business, what you actually own, what you owe, the equity equation, and finally, revenue versus expenses. Let's get to it.
Section 1. The language of business.
Just like picking up a new dialect, mastering accounting really means learning to read a company's financial story. The pros define it as the art of recording and classifying transactions, but simply put, it removes the guesswork and gives you a crystal clear picture of reality.
And here's the beauty of it. Absolutely every transaction in your business fits neatly into one of these 5 basic categories: assets, liabilities, equity, revenue, and expenses. This chart right here is the absolute backbone of your financial reporting. Understand these 5, and you understand the whole flow of money.
Moving on to Section 2. Assets, or what you own.
We're going to spend some quality time here because this is the true foundation of your company's value. Simply put, assets are tangible and intangible resources your business owns that pack real economic value. It's a resource you control, and you expect it to deliver future economic benefits. Whether that's cash sitting in the bank or the equipment used to run your operations, your assets are the literal engines of your growth.
Now, crucially, not all assets are things you can actually hold in your hand. Tangible assets are physical. We're talking cash, buildings, vehicles, equipment, and inventory. But intangible assets, things like patents, trademarks, copyrights, or accounts receivable, which is basically just the money your customers owe you. These are non-physical, but just as powerful. Think about a famous recipe or an iconic brand logo, completely invisible, yet massively valuable.
We also classify these assets by liquidity, basically how incredibly fast you can turn them into cold, hard cash. Current assets are things you expect to consume or convert to cash within 12 months. Think inventory. Fixed assets, or non-current assets, have a lifespan well over a year. Think factory machinery. These aren't very liquid at all, but they're heavy hitters for your operations.
And because a fixed asset, like a building or a massive vehicle, is so costly and lasts so long, we don't just write it off all at once. Instead, we depreciate its value slowly over time. You recognize the cost of that asset gradually, which mirrors exactly how it delivers value to your business over its lifespan.
All right, on to Section 3. Liabilities, or what you owe.
Because every scale needs a counterweight, right? Liabilities represent future outflows of cash. As you can imagine, they can be a serious burden on a business if you aren't tracking them perfectly. They're present obligations from past events. Basically, the money you owe to lenders, tax agencies, suppliers, or even your employees.
And just like we did with assets, we split our debts by time. Current liabilities are your short-term operational bills, things you absolutely have to pay within 12 months, like accounts payable or wages. Long-term liabilities stretch out over years, like the mortgage on your office building or long-term bank loans.
Next up, Section 4, Equity and the Accounting Equation. This is the pivotal moment where we tie what you own and what you owe together. Equity is your true personal stake. It's exactly what's left over for the owners once every single debt has been settled. If you literally liquidated every asset and paid off every liability today, equity is the net worth that actually stays in your pocket.
So here's the absolute golden rule of accounting. Assets will always equal your liabilities plus your equity. Think of this equation as a perfectly balanced scale. The resources a business owns didn't just magically appear out of thin air, right? They were funded by either borrowing money or by the owner's investment.
Let's see this in action. Say you buy a $30,000 delivery truck. That balances perfectly when it's funded by, say, a $25,000 bank loan and $5,000 of your own cash. $30,000 in assets exactly equals the liabilities plus equity. It's just a beautifully logical system.
Finally, let's hit Section 5, Revenue versus Expenses.
Now we're transitioning away from a single snapshot in time to the daily operational flow that actually changes your equity. Revenue is the starting point of your profit. It's the money flowing in from selling goods or services. Expenses are the necessary costs: the rent, the marketing, the resources you literally consume just to keep the lights on and make that revenue happen. Think about a coffee shop. Every latte you sell pushes your cash assets and your revenue up, but every utility bill you pay pulls your cash down and increases your expenses. Recognizing this flow is absolutely crucial, because the difference between those two numbers, that's your net income, your ultimate bottom line. So,
Understanding this language completely removes the guesswork from your financial life. I'll leave you with this challenge today. If you were to map out your own business or personal finances right now, how would you categorize everything you own and owe into these 5 buckets? Are your assets truly working for you, or are your liabilities quietly draining your net worth? Thanks for joining me for this explainer, and definitely take some time to look at your own scale today.